Hi, welcome to episode 3 of the OpenVC podcast. In today's episode, we're going to be interviewing Felix Keus. Felix is the managing partner of Aurelia Ventures, a really unique fundraising program. It lasts 1.5 to 2 years. They're hyper selective of their B2B SaaS companies that they take on, and their portfolio have gone on to raise over $250 million from top tier VCs. It's a really interesting episode for any founders considering an accelerator course. Felix gives us some great insights over what to look for and what to watch out for when it comes to selecting an accelerator program, and it's a great episode. Let's get stuck in. I'd like to introduce our season 1 sponsor, intercom.com. Intercom.com have an AI purpose-built customer support product, allowing you to support your customers 24/7 and answering customer queries instantly. In fact, they can answer 50% of your customer search volumes instantly. And I'm delighted to say that using the code OpenVC, all in caps, you can get your first year completely for free. That's intercom.com, use the code OpenVC, all in capitals, and you can redeem your first year completely for free.
Thank you so much. Very well. Thank you so much for having me.
No worries at all. You've got a very interesting career, and I'd love to kick it off with questions in that space. So you currently run Aurelia Ventures, which is a scale-up program for founders looking to raise funding. But prior to that, you've actually built and run 2 companies in wildly different spaces. One in the fitness space, Elevate, and one in the finance space with remittances called Finex Remittance. So could you just take a little bit of time and tell the audience what brought you to starting those 2 companies?
So actually there are more companies that are not even listed on LinkedIn. I had my first kind of company with 2 friends from my class. We did basically e-commerce and dropshipping before dropshipping was a thing. So before we all had AliExpress and all these kind of things, we basically actually saw stuff already from China and then basically sold it on eBay back then. So that went pretty well. But again, like high school has obviously different priorities than scaling a company, or at least for us back then. And then afterwards, I did my Master's in Innovation Entrepreneurship in EDISADE in Barcelona. And so obviously there was a lot of entrepreneurship and pieces in there, really great school for preparing people for entrepreneurship and hopefully the uncertainties people are going to face. And then afterwards, I started a venture studio, or like we glorify it as a venture studio. It was really a friend of mine, very quickly prototyping projects, hacking it together, see what flies, see what doesn't fly. And then, if something catches traction within 2 weeks, then we're going to continue it. If not, it's going to be basically killed. And so had there a really cool company as well. And then, as you already mentioned, moved over to India and basically started Finex. Good question. Why these kind of different verticals? Both were, or like Elevate a little bit less, but both were basically B2B applications. So I had a very strong B2B play there. I personally love the business-to-business model on the software side a lot. Understand obviously the sales the best. Was never a big B2C guy, and so that is really the reason why different verticals, but still somehow in the B2B SaaS space. And both companies really had the purpose of leaving something bigger in the world than, doing companies. It's always, we founders already commit so much time and all their life basically to something that is hopefully bigger than just the purpose of filling their wallet. And so really enriches other people's life. And so that was basically the rationale really behind any company I would do. And so, I think the purpose was really to help people who work in the UAE or Saudi Arabia to basically get their money very cheaply and quickly over to mostly India, cutting Western Union. Again, like a little bit ahead of our time. So before Web3 and blockchain and crypto and everything was really in the mind of everyone. We did that already. Ripple distributed ledger protocol for basic currency conversion. I met my co-founder through one of my classmates at EDISADE, then basically moved just to India to basically meet him and scale it there. Great experience for 5 months in India, and then afterwards a year in Dubai. But then it was time after 1.5 years to do something else. Faced obviously regulatory challenges we as young entrepreneurs couldn't really anticipate or should have anticipated, and so great learnings there along the way. And then Elevate was really the purpose of bringing a more holistic fitness or like more holistic health regime to people, especially in companies as well. So the idea there was, why do supermodels and everyone get so extremely slim and, well trained and everything directly after pregnancy, for example, after, different kind of roles. And the reason is that we have our specialists usually at their hand. It's usually physiotherapist, personal trainer, nutritionist, and potentially sleep advisor. And so we're like, hey, it's a time of AI. Why don't we put everything together in one application, sell it to corporates potentially as well? And so through the top-down approach, through corporates that give it as a health benefit to their employees, and did that back then in Hong Kong and then Singapore, and basically not started on the side, but I always had, I really love business. And so I always usually do multiple businesses at the same time. And so I have my main business, which is, great and everything, but I always like to prototype stuff on weekends or, And so Aurelia was before we officially started this for 2 years already kind of my side project. So my friends always reached out to me. It was like, hey, how do I raise capital? How do I scale a company to 40 people? How do I do all these kind of things? And at some moment, especially with, you can imagine we were at the beginning of COVID back then, and we had a health company that lets people work out. So really great when all the gyms were closed. We took a little bit as a sign to say, hey, why don't we focus fully on Aurelia Ventures and really, really scale this? Has been fantastic experience so far over the last 5 years. Really enjoy the work.
Awesome. Wow. What a journey. In terms of that entrepreneurial bug that is clearly still very much a passion of yours, did you catch that from anyone? Were people in your family business minded?
Excellent question. I would say my uncle and my father, my grandfather, they all have businesses, but everyone does something very, very different. So my dad and my grandfather both in real estate, but I never really looked much into their businesses. I found it very traditional kind of business. My uncle is more in retail, and everyone out there are horrible with tech. I think what predispositioned me back then for entrepreneurship is I really love figuring things out. I like two things a lot. One is systems. So how can you systemize things that's beautifully run by itself, hopefully without hiccups. So this is something I can even say obsessed about. Might be the German in me who really love these kind of things. I don't have much interest besides business and these kind of things to really do this. So I'm pretty obsessed about these kind of, figuring things out, systemizing stuff, scaling things. And so that was always something which already, when I was 8-10 years old, really trying to get to the bottom of topics and, sit on something over the night and just really, dig deep into topics to figure them out. And so that was something which was always kind of part of my personality. And obviously that goes very well with entrepreneurship. If you really want to be obsessed about one topic and figure it out and scale it, usually it's good for entrepreneurs to have that.
That makes a lot of sense. Being an entrepreneur, there is 1,000 problems a day, and you're the only person that can solve it, and the only person that wants to solve it, and everyone else is giving you problems. But you've got to maintain that resilience, that intellectual curiosity, creativity, and then also the practicality of actually executing and getting things done. So I think your experience being a co-founder, even from a really young age, and having these companies and having setbacks as well, has positioned you perfectly to be in that venture building space, particularly founders and people that haven't done it before, because they're learning off your experiences and you're able to look ahead and say, hey, this might be a roadblock, so you might want to consider A, B, C, and put that potential barrier. In terms of Aurelia Ventures, could you give us a brief overview of what you do and what the scale program is?
Sure, 100%. So the first accelerator was started around 19 years ago. So it's a very, very long time for our industry, obviously. Still 95 to 99% of the participants die. So if you're a doctor or if you're a surgeon who's doing surgeries for 19 years and 99% of your patients die, it's not a great rate, right? There must be something wrong in the system somewhere. And so obviously coming from the entrepreneurship background, went through incubators, went through accelerators, went through the whole early stage right a couple of times. I'm seeing with my friends, obviously being really passionate about businesses. So seeing it with other kind of line of businesses as well. I was like, hey, why don't we build something that is simply more helpful for founders, and how could that look like? So what would I as a founder would have loved to have? So it comes very clearly from this kind of founder problem, building something for other founders. We said hey, a couple of things that must change in the industry. What we have done is, instead of running a cohort structure where you put basically a couple of companies into a cohort, and then give all of them more or less the same kind of content. Obviously, you pair them with mentors and everything, but basically the cohort and the kind of colloquium is all the same, and you do that on a regular basis. There's simply a couple of things are wrong with that system. Is first of all, it's very too short. So usually these cohorts running for 2 or 3 months. We define early stage as from idea stage to having raised a seed round. So this could be like with the newest pitch book reports, it's usually around 2.5 years. So it's a pretty long time period. The problem is if you just have a program that runs for 3 months, there is a very, very big delta that is simply not covered anymore. Sure, you can reach out to your accelerator. Sure, you can hope that you get some help, but you are basically the old batch. Then as well, founders startups are pretty unique kind of entities, right? So they're very innovative, forward-looking, they potentially disrupt industries, and then they're made up of founders who are as well these very individual kind of people who think differently, who do everything differently. And now someone thought that it's a great idea to put 30 of them in the same kind of classroom structure and tell all of this. It obviously doesn't work. So what they need is someone who's basically on their side whenever they need help, that they can reach out at any time, who has done it before, who knows the pain they go through, the challenge they're going to face, and help them with their one respective issue they're facing at this moment. Not with more, not with less, exactly what they need and as much they need it. So I can tell you, we have sometimes sessions where we speak for 3.5, 4 hours about only pitch deck, nothing else. And about only this one pitch deck, obviously the founders are building right now, because afterwards their issues are actually solved and they can continue and basically, operate on the knowledge. We work with founders for a very long period of time. So usually we say between 1.5 or 2.5 years, or basically the milestones we set for ourselves is they've raised a seed round. They either have raised a seed round, they have $1 million in ARR, or they have 50 people on board, because then usually inherently companies change. They're becoming a very different kind of more motion, which goes more towards sales and market growth. And this period is usually 1.5 to 2.5 years. We only work with one company a month. So very clearly, we only take one company in the program per month. So there's not more, because we want to have enough airtime with each of them. We want to have enough quality time with each startup. And then we usually focus with them very strongly on everything fundraising rate, because that's usually what companies or with founders understands the least, because if they haven't been a VC before or invested in a significant amount of companies before, they simply can't know what is relevant in the market. And we've seen over the last 3 years, markets change very rapidly, especially the fundraising environment. And that's usually the thing where we need the most help with, and then really everything, the GTM, sales, marketing side. So what kind of revenue targets do we need to hit? What have you seen at other companies? What works well for them in terms of LinkedIn cold acquisition? How do we sell to enterprise? How do we price our product? How do we know we are not too cheap right now? How do we know we're not too expensive? All these kind of questions they all have, they need to figure out, obviously. And so recently someone described this as a cheat code to early stage, which I maybe put it one day on the website, because I like it a lot, because that's literally what we do. We are there to save their time, stop the trial and error stuff, and just tell them exactly what they need to hear. Coming from the perspective of a former founder who has done it a few times, has his fair shares of hiccups and failure along the way, because these are usually really great learning experiences, and now doing basically VC for 5 years and understanding very well how the investment side works. And so one thing as well, which is usually kind of an aha moment for our founders, is when we tell them actually what VCs need to see from them. Because VCs, if a founder reaches out to a VC and asks them for, hey, we would like to pitch our product, we're going to pre-seed, seed, whatever they do, the VC very, very likely will not give them an honest answer. And that is not because VCs are not honest. It's simply they don't know the founder well enough to trust them enough to give them fully transparent view. Maybe the founder just takes and puts on Twitter and says, wow, look at this VC, how rude, or whatever it is. And so this kind of stuff is obviously danger. Then second of all, VCs usually don't like if you can look into their cards and understand all the inner workings, because you could potentially reverse engineer it and manipulate the system and then get a couple of millions of investment without actually having what you need to have. And so for us as well, it's another way, I'm not sure if I should share that publicly, but for us as well, it's a great way of building introductions for VCs, meaning when we reach out to one of a VC we don't know yet, and we say, hey, we have a portfolio company that is raising, then this is a much more relevant, obviously, introduction than if the portfolio company would just be one of the many, many cold outreaches. I, in my personal email inbox, get around 20 to 30 cold pitches every day. it's overwhelming. And so what do you do, especially on the early stage, which is not Series A, Series B, or growth stages? What do you do at this moment? You apply pattern recognition because it's too much content to significantly cope with. And so founders are always very surprised when they say, hey, the VCs only look at my deck for a minute or 1.5 minutes. Like the last DocSend reports, the VCs look at the deck like 2 minutes, 10 seconds, something like that. Mm-hmm. It's not that they spend that much money to really understand the company holistically. No, they're looking through it very quickly to do pattern recognition, understand if it's something for their fund because they're very, very niche, and to move it forward or not. That is the only thing that needs to be answered, and that can be answered in 2 minutes. So yeah, there's a lot of translation between this side and that side, and really, really being extremely transparent with our founders obviously there.
Thank you. Well, there's a lot to unpack in there, but there's a lot of good advice as well. So I think I'm going to bring it back to the health analogy that you mentioned earlier, and how accelerators historically have not been very good at saving their patients or keeping them alive. So in contrast to that, Aurelia, you're almost like a precise surgeon. So you've cut your teeth in B2B. You've had 2 startups in that space already. And then you stick with your patients for 1.5 to 2 years, whereas other accelerators are actually only sticking with their patients for 2 months. And that combination of expertise and the right help at the right time, it seems like a really unique combination of factors that isn't replicated by many other programs at all. In fact, that might be the longest incubation program I'm aware of.
We should put that on the website as well. That's a good sentence. I like that.
Awesome. When it comes to the startup founders that are looking to apply to Aurelia, what are you looking for? What helps people stand out at that early stage that really makes you want to get involved?
Yeah, excellent question. The program as we run it right now really resonates well with founders who have usually a little bit of startup experience. So that could be a little bit to a lot of startup experience. Like we had founders that have previously exited for significant money, so the next generations don't need to work anymore. But since if you do it once, you're really addicted to it, and so you're going to do it again. With really fantastic exits, and so the founders that they come to us, they know they need help. They are aware of all the challenges they face. They know industry is changing all the time so rapidly, and they need someone who gives them the TLDR to everything, because time, especially right now with all the Gen AI boom and how quickly companies come up right now, how quickly business models are developed, time is even more of essence as it was pre-November 2020, when all our world picture or worldview was basically disrupted by ChatGPT goes live. Coming to us, and what do we look at? We usually look at founders. One of the criteria we have is they can build it inside. So they can build it inside of the company. They have a CTO founder, tech founder, someone who, even if they would have not any money, they could, with time, build the product holistically by themselves. There are always elements sometimes that you say, hey, I don't know, I have someone who does this database for me or whatever it is. Or like we have like an external data scientist, fine, completely fine. But the reason is, if the company faces difficulties, and they will face difficulties as every early stage company will do it, we can't rely on an outsourced team or potentially capital they need to distribute. Or like if they need to have $50,000 to bring the company forward, otherwise it dies, it's a really, really bad thing to have if you're an early stage founder. So CTO founder there. Another one is a everything else founder. Call it a CEO, COO, CIO, whatever they want to give them for title. Basically someone who does everything else, from fundraising to business to marketing to sales to potentially legal, accounting, whatever it is. Someone who keeps the company together and running, so the CTO can really fully focus on building the product, and the everything else founder, who's basically out there, gets the insights potentially from the POCs, from the early customer conversations. It's like, hey, dear CTO, this is what they tell me, what is really, really important. Can we incorporate it? How long does it take to develop? So these two elements need to work together. 2 is great. 3 founders are awesome as well. We recently have a company, we took on board really, really awesome guys as well. They're 4, very strong engineering background, works really, really fantastically well. So that is one thing, so they can build internally and they can scale it internally without external help. Another one, they need to understand the industry they're building in on a level that allows them to have understanding of the underlying dynamics. So I can tell you, we had one company we spoke with, they're coming from private wealth consulting, so they were at JP Morgan before. for the last 10 years. They just understand something about wealth or like wealth management that potentially not many others understand if they just want to do a fintech startup or something like that. So they have insights in the industry that other people don't have. And so that allows them to decipher the kind of things and tailor the product in a way that nobody else would not have this kind of background could do it. So these two things are usually most important for us. Since we are very early stage, so we usually meet founders without funding, if they have just raised an angel round, if they just did a small pre-seed. So these are usually the kind of stages where we meet founders. There's so many uncertainties in there. And even for us as someone, like we recently went to our backend and looked into the BI. And so over the last 5 years, we have more than 1,000 interviews or introductory calls with founders. We got a little bit more than 5,000 applications. We did a due diligence, I think, on 2,500 companies back then, and 140 portfolio companies now. So we have seen a lot. And even with all these data points, and we are very data driven, we track a lot, we understand, okay, why did where did we reject a company? Why did we lose a company? Like we track everything in there, and like because at some moment we want to go back and say, okay, this company is doing fantastically well. What did we not see here? And this is usually like, it's a terrible thing when someone in Slacks puts about like kind of a TechCrunch article or something about one company. It was like, oh man, I remember that name. What are they doing? And then you basically go back and you check them. I was like, why did we not see this? And so it's always good to reverse engineer and see where you have blind spots. Nevertheless, early stage, there's so many things that can come your way that you don't know, your investor doesn't know, nobody can anticipate them, and they just come. And they basically just get faced with it. So we try to do our due diligence as perfect as possible, but there is always an inherent early stage risk that you have simply at a pre-seed stage that every company has.
I think that's part of the beauty of the game. There isn't a formula. It's not a mathematical equation. There is this level of uncertainty, and everyone believes that they have an edge, and that's why they're sort of playing the game, because they think they can beat others. And actually, there are things you can do that will increase your chances, but it won't ever guarantee outlier results.
And by the way, just following up on that, the kind of edge, that is something what we usually see from first-time founders, or when they come from corporates, tech corporates, where they're very, very senior positions. So we have people who were directors at Google, Uber, Airbnb, all these like very, very high-level people. Recently as well, someone else was before the CTO at one of these tech companies. So very, very experienced people, very high level. Now they're doing their first startup. The problem what we usually see with first-time founders, and I don't want to call it ignorance, it's maybe just a level of I don't know what it actually takes that gives them a certain kind of naivete to it, that they are very, very confident how things will turn out. And the higher up the hierarchy you were before, the more confidence you have that it happens. So sometimes you see people like without any founder experience, they haven't done one company before. They might have rolled out projects internally and scaled like internal initiatives, and then they went live within Google. All great. The problem is just, if you're doing this, you have close to unlimited resources. You have the best engineers that obviously all work at Google or at these tech companies. You can pick these kind of people. You can just run it internally, and then surprise, everyone wants to hear about it because it comes from Google. You know what I mean? Like, oh, Google is running something new. Wow, you get all the TechCrunch coverage now. Great for you. So they have all this kind of success and gives them even more confidence. Now they're going out the first time and doing it by themselves, and there is no Google name anymore besides on their LinkedIn as a past position. Engineers are not like, sending them emails every day. Oh, we want to work at your place potentially for free because then we have it on. So they need to pay salaries. They don't have unlimited resources anymore. Customers don't take calls with them, or maybe take calls with them, but just because they want to see who is that guy or girl. And they think all that kind of stuff is traction. Very similar with VCs, by the way. VCs love having first conversations. They love them because they would rather be 2 years too early than a week too late on a deal. And that's the reason why they take calls all the time. And the more high-level companies they have on their LinkedIn, or the better the universities were where they went, the more likely a VC will take a call. That doesn't mean this is an investment. Meaning, we see Stanford grads who went to Google and all these kind of things. VCs are queuing up to have calls with them, but that doesn't mean they will invest in you. Just because they take a call it is not a signal. If you have a term sheet, if you have the money on your bank account, that is a signal. But everything else is just noise. And first-time founder doesn't know what to look for. All the stuff looks like signals. They get extremely confident. And then we usually see them hitting the floor pretty hard after some time, because maybe they're able to raise like $1 million from some people angels who say, oh, wow, ex-Google, great, let's give them the money. But they are not able to achieve the milestones that are required for institutional investors, and institutional investors are private equity firms. At some moment, they don't care where you come from, which university you went through. It only matters if you're able to build successful companies. And then they're usually, getting the first kind of success feeling, and then they basically fail their companies. And we see that actually quite a lot. And so trying to communicate that all the time to them. Sometimes they listen, often they don't listen. And that's the reason why more experienced founders usually resonate with our program better, because they know what they need and they're very quick usually on executing. They don't waste any time on these things.
That's really insightful. And actually speaking to some of my friends that work at the likes of Amazon and Google, and the number of hours that they actively work during the day, and the free breakfasts and the free lunches and all the perks that they get. It's the polar opposite of being in a startup, where 99% of what you do ends up in resistance or no or fails. And even just staying positive, beyond having a monetary success, it's a very different mindset to have that resilience, to leave all that comfort and actually hit the uncertainty that comes with being a founder and everything that can go wrong.
Like I would much more bet on someone who joined a startup as like employee 5, 6, 7, 8, 9, 10, went with them through the whole pre-seed to Series B growth, and was potentially on their sales team. Someone like that is amazing for us, because they saw how the growth actually works from the beginning, from scrappy with no money, nobody knows us, we need to sell to enterprise somehow, all the kind of issues they're facing there. That is someone who understands the kind of hustle and saw the challenger that a company potentially died multiple times along the way, and have this kind of learning experience. Even if they're not the founder, that would be for us much more, they have much more muscle memory in these kind of things than someone who was, employee number 25,908 at Google, because they haven't seen the kind of early stage growth they need to apply right now at the pre-seed stage, because each stage is so different. Even if they did Series C to Series D on their growth department, it is so different than pre-seed to Series A, and you can't apply what you know there to the early stages. And so that's kind of things we're looking at. Long answer to a very short question.
No, I completely agree. I think you're bang on. In terms of founders that do need help, that join the program, are there any examples that you can share with us of how Aurelia has changed or dramatically increased the chances of success for some of your portfolio companies?
Yeah, we usually see it with all the companies. Every company that comes to us comes usually with an issue. They have something that is happening right now. It's not all sunshine all the time, because it's early stage. So they're coming to us and say hey, just raise a pre-seed. Somehow I need to reach the seed round. I don't know what it takes at a seed round. I don't know how to get there. Help. Or I talk for the last 1 month to investors. We have a lot of calls, but for some reason everything is just stopping. What the heck is going on here? So there are a lot of these they usually come to us with fundraising challenges, or now we need to execute sales growth or sales goals on our promises that we made to investors. And so usually that takes us, there's no ramp up period where you say, oh cool, the first week we you get the community, the second week we have no, it's usually immediately hands on, full on in one company. Share everything with us. What do we have right now? What are the answers you're getting? Who did you talk to already? What is the feedback you're getting? And just really, as a founder basically would do it, go full on in and say, show me your deck, what is the data room, and basically do a 360 deep dive in everything, if it's fundraising, for example, in everything they have, because they're 100% somewhere red flags. We see somewhere it's a financial diligence, basically discover maybe the legal things which already give us kind of a headache, but we know we can fix them, so that must be fixed. And so basically just looking from the perspective of investor on a company and telling them this, that needs to be changed. The deck here, we need to change this message, use this, basically doing like looking over everything and changing a lot of things they basically haven't done before, and then basically starting the proper outreach, creating momentum obviously for a startup, about like sharing regularly good news, having the investors who maybe said no still in the loop. Like there are a lot of these kind of ways and kind of strategies around that to basically do a fundraising really, really successfully. And it's usually just putting all the pieces into place, which are right now just scattered all over the room basically. And so yeah, we had like companies that come to us and say like, okay, for some reason I don't get any calls with VCs, and we look at the deck and it's extremely technical. It's way too technical for the first deck, and so threw the whole deck out of the window, did it from scratch. We have as well deck designers and everything on board, obviously. So things that look pretty, are usually easier to digest. So okay, and the information are just formatted in the right way, and boom, now they have like all these kind of partnership meetings immediately. The next call is, I don't know, this VC, we spoke with them, they don't get back to us. Or after the first call, they tell us, yeah, it's not a great fit. When we do introductions to VCs, they usually tell us as well, hey, it's not a great fit because X, Y, that. We obviously don't, on the one hand, we want to have obviously very strong network with our VCs. On the other hand, obviously, we want to help our founders. So we give them pointers, what could potentially be the reason why other VCs don't say it. So no straightforward kind of answers because they don't have trust with them, but we know to a certain extent how much we can trust all of our founders. We know them, we work with them on a nearly daily basis on all these kind of challenges. So we have a different way of translating what the VC really has for an issue to, hey, look at this right now. And in that way, they're getting information they would never get from anyone, and that can basically optimize their process and basically run through it. And so it's usually that we're unlocking certain kind of conversations they will have, we're unlocking introductions they will not have, and then as well just bringing the whole process with a really, really strong partner who's doing it for 5 years basically to a successful end. With sales and marketing, it's a bit different. It's more like founders have a broad idea how it works, sometimes even very good idea because they've done it in previous startups, but they're more coming to us and say like, hey, how do other startups do this right now? Like I have sent out so many emails and for some reason it's not working. And then we have email deliverability on experts on board. So they do the technical setup of email domains, for example. Obviously there's a ton of going in what are keywords in subject lines that immediately brings you to a spam filter. So there's so many kind of things they simply can't know, or very often don't know, that we say, hey, this worked at company XYZ a month ago. Why don't we apply this here? And surprise, it works there as well. So it's just bringing this kind of swarm intelligence together from what we see from all the other companies at the same stage. What are they doing over all the last years? And basically taking all this knowledge we acquired over the last with so many companies over the last years and putting it immediately to work on one company.
I really resonate with your insights on pitch decks being too complicated and founders trying to throw everything into their first approach to a VC. And actually, in reality, the decks, they're read by the associates, the analysts, sometimes the interns, because VC funds get so much inbound. And they're just doing the noise filtering. And these guys aren't technical experts. So you do need to just hit some of the basic requirements, be able to explain your idea clearly within the first 2 slides. Things like that really help you get in the door. And if you don't do it, you can be harming your own success and your ability to get a first call. And actually, you also touched on email spam and domain authority, which was one of the major reasons why I think my first startup failed flat on its face, because I'd never heard of those things before starting. And my web design agency hadn't told me about those things, but I was quite reliant on it. And that's still a bit of a sore point for me. In terms of deal flow, you are, or Aurelia is an active user of OpenVC. Have you guys seen any good deal flow from the site? Have you made any approaches or investments from deals that you've seen on there?
We can't obviously give away all of our secrets, but jokes aside, now OpenVC has been actually a fantastic source for us, to be very honest with you. That's a good question. When did we start it? Probably around 6 or 5 months ago, looked into it more intensively, and now basically using OpenVC nearly on a daily basis through sourcing, reaching out. Companies find us as well. So OpenVC has been a really fantastic kind of customer acquisition platform, to be honest. Sounds so startup like. We meet great founders basically.
Awesome. That's a great testimonial. Thank you very much for sharing. Yeah, that's great. In just coming back to Aurelia Ventures, what's the pricing structure for the founders that are curious? So it's 1.5 2-year program. They get one-on-one, loads of time with you guys.
The founders who come to us usually don't need $100,000. And I'm saying this not with a kind of arrogance that money is not important at the beginning. It's more, they worked before at Google, exited before, maybe they just worked in a different job for a long time and have savings. The founders who come to us say, I know I need help, or like I want help. I want someone who has done it on a repeated basis all the time, and I need the kind of insights, but I don't want to give up 8%, 10%, 9, 7, 6, whatever it is in a typical accelerator incubator model. Why? Because if you give up 10% before your pre-seed round, in your seed round, 10% is worth around $1.5 million US. And usually our founders go on seed rounds after 12 to 14 months, like from joining the program. So in a year, you could have saved $1.5 million by not giving up 10% that early. And they know that because they have done it before. They're not the first-time founder. We're coming from the perspective of what are all the other actors out there doing. So incubators, accelerators are usually between 6 to 8%. And so obviously they give some capital. But again, often the founders don't want capital. They don't need capital in this moment. The $100,000 is not worth enough. The $100,000 in comparison to $1.5 million is not enough value for them. Easy as that. Then you have all the kind of, how do you call it? Startup introduction, fundraising people who do like startup fundraising. The fees usually vary between 3 to 5% of your raise. So they're happy to raise $1 million. They get $30,000 to $50,000 from that. So it's usually a ton of money. Many of them are not licensed, so you need a broker-dealer license in the United States for that. It's SEC regulated. If they don't have the license, the startup and the finder, referrer, broker, however you call them, can get in significant trouble for that. So this whole success fee model is obviously there, more predatory than anything else. And we came from the perspective of saying, hey, how much would you give up to 3 advisors at your current stage? And it's usually around 1.5%. First of all, it makes a ton of sense for startup founders to understand, hey, 3 advisors, best case, I speak with them 1 hour on a weekend. And now, on the other hand, I get from Aurelia Ventures 60 mentors, 250 VCs in the network, 140 portfolio companies, baked in knowledge for the last 5 years of just doing venture and 8 years of before doing my own startups, getting all this kind of stuff on a personal basis for 2.5 years for only 1.5% of the company. And they're like, okay, wow. So there's right now the real value exchange. And it's funny because sometimes we have founders that come to us with like, hey, cool. So every year you now get like 1.5% from us. I was like, no, one time. It's not a yearly thing. It's not a recurring. It's a one-time thing. They're like, what? How do you do this? And so it's a lot of...
It's sweeter than that, though, because you actually also invest. You're not just taking the equity. You're doing pre-seed and you can... Yeah.
Full disclosure, we don't invest in all of our companies, but we can invest in them in the pre... Like, we have capital to invest in them in the pre-seed and seed round. There is no requirement. If they don't like us, they don't need to take our investment. So there's no, kind of clawbacks or like, options or whatever it is. But usually our founders are so thankful. They say like, hey, cool, you guys are really, really awesome. You helped me already. Do you want to participate in the round? I was like, yes, sure, obviously we want. On average, we spend around 600 hours with each company. So you're getting a fully dedicated team on a personal basis on call for 600 hours over the next 2.5 years who know how to guide you through the next kind of significant fundraising rounds for like 1.5% of the company. We even think about like increasing that, to be very frank with you, because it is a lot of work. There is no question, and that might be as well the reason why not many other people do it. And obviously running a cohort kind of structure with like, always the same kind of content in there and then pairing mentors, it's obviously, if you can break it down to the single company, it's obviously much less work than working with them on a personal basis for 2.5 years. But I personally like the early stage, and maybe it's, mental disability I have. Like I really like this kind of, chaos sometimes, the kind of a little bit of anarchy there, is the kind of work you're doing with them. And I'm just really, really passionate with it. And that's the reason why we build it in this kind of way.
You expect it to be priced as a premium product, but actually you've gone to the market, you've understood what it takes to get these founders that are actually top class and found a win-win situation. Wow. It seems like a really well-priced product, and I'm not surprised that you get so much inbound and you actually get to pick So, I mean, just to set expectations for people applying, on your website, you say you might take one company on a month, and actually
Or
sometimes you
none.
might take none. Yeah. So
Yeah.
it's a very exclusive program to get into.
Yeah, but we don't want to make it exclusive like it's not meant in an exclusive or elite way or anything like
Mm.
that. It's simply our promise to our founders to have enough airtime with everyone. Meaning there's certain things you can't scale. You can scale certain automations, certain kind of knowledge transfer and everything, but having the time with someone who has done all these kind of things before in a call, speaking with you, and potentially this call takes like 3 hours because we need to deep dive so deep in certain kind of topics. You simply can't scale it. So if I find another person like me, I could reproduce myself, but then we would have 2x, and we potentially take 2 or 3, like 2 companies on board per month. But it's simply the promise of the companies that we have in the portfolio that we tell them, hey, tomorrow we're not going to take 10 companies because that would simply limit my time to an extent that I wouldn't have enough time with you anymore.
It's really refreshing to hear because the amount of accelerators that have popped up that are actually predatory and don't add much value at all to their portfolio companies is scary. So so say there's a founder listening who's not in B2B at the moment, but they are considering going into an accelerator.
Yeah.
What are the top 3 factors that you'd recommend they consider when selecting a different accelerator program? The ones that actually make a difference that founders might not be aware of when they're selecting.
Questions we usually get as well, and which I like a lot, is what is your success rate? How many of your companies have gone on to raise a pre-seed or seed, whatever the goal of the startup that applies? How many companies of your total portfolio are dead? Like, this is usually something to know as well. So ask these kind of questions, how many actually go on and do something successfully. Read the agreement in detail, including all fine print, and make sure you understand everything in there. If it's a 20-page agreement, make the effort and understand it fully. If you don't understand something, Google it. The due diligence you do at the beginning is so much more worth than you're going to do afterwards. There was like one program. It's not existing anymore. They saw their program, and it has terrible clauses in there. Terrible. Something like, if you join our program and, how was it? You have raised in the last... You're not raising in the next 3 months, we can invest at your previous valuation in a year or something. So let's say this company is not raising in the next 3 months. The last valuation was $1 million. Then they can invest up to $500,000 at $1 million. So they can buy 50% of your company if you don't raise in the next 3 months and next higher round. And so there's so many of these kind of terms out there where you're just looking at things like, holy smokes, how can anyone ever say that? But then again, like, you have the founders who simply don't know better. And they, first-time founders potentially, they're only here to the promises, they don't read the agreement, and then they're just out. And they just sign this kind of stuff. Where you have something like, we saw that recently, you are on our program for like 3 months, and then we have the chance, you're not allowed to go to other VCs or investors or any other capital person and raise from them externally. Then after 3 months, you're coming to an internal review. Then we have the chance to invest in you, and then you're only allowed to go out there. I was like, holy smokes! They tell me that I'm not allowed to raise capital for my own company, and I signed this off. It's like, it's mind blowing to me.
So I think in the last 3 minutes, you should help a lot of founders thinking about joining an accelerator avoid a lot of mistakes. I mean, as a general rule of thumb, make sure you read your contract and understand every sentence, because they're designed sometimes to trick you. And so if there is a bit of uncertainty about a clause, it's probably not for your benefit.
Yeah. And these are sometimes huge accelerators, right? I know accelerators that have like 500 plus portfolio companies, and they have these kind of terms in there. So that's the reason why founders should, like, are usually in our program, because we tell them exactly these kind of things. Like, one thing, for example, what founders usually don't understand is they're going out there on LinkedIn, seeing a post. Like, pre-seed rounds are on average right now 1.5 million, or like 1.5 million on a 15 million valuation, or to 14, whatever it is. There are always these kind of really, really great statistics out there from people who are either too lazy to really slice the data, or simply just want to have spectacular headlines because, surprise, that brings engagement. So if we would be really, really honest, and I would say, hey, I have an B2B SaaS infrastructure company for enterprise, and I'm falling into the enterprise SaaS model, and I'm falling into the infrastructure model. So I need to understand and if I'm in the United States, I need to understand what those companies raise in the United States over the last 5 years. And so we have founders that basically are coming into our programs like, oh yeah, I'm doing a pre-seed right now. My valuation is only 11 million because the average is 14, so I'm cheap. The problem is just, this is not reality because they're mixing together B2C dating apps with like Anthropic or something, like which the variety is just, okay, Anthropic didn't do a pre-seed, but you get the idea. It was like companies that are so massively overfunded right now, you're already on a pre-seed stage. And average just means you're taking all the values together and you're dividing it by the numbers of your data set, and that is the average. So if you look, for example, for the median and the average, you're going to see that the average is 1.5 million of the round, but the median is on $500,000, meaning 50% of all companies haven't raised more than $500,000. And then you have these massive outliers which are just dragging the average above. And this is the same with the valuation. And so now we have companies. They told us we are cheap on a 10 million valuation. We told them do an 8 if you want to have a conversation. And now they're getting term sheets for 7. So,
and that's probably still in the top quartile for similar companies in that space. Yeah, and that's exactly what it's all about, because that's what VCs are comparing you to. They're not comparing you to the average. They're comparing you to what else they can buy at that price.
Exactly. And then they don't understand, many founders don't understand how public markets, how LP sentiment right now plays into fundraising strategies. Like, we have right now we're in a situation of an oxymoron, meaning we have the most dry powder, so money that investors can invest in this year, the most we had in human history in the United States. It is so much money. I think only in early stage venture capital we have like 350 billion US dollar. It's so much money. So when I say, hey, cool, there's so much money, VCs need to deploy, we can raise right now very easily. No, because LPs, the people who invest in VCs, don't invest right now in VCs. I'm very, very careful of doing follow-on investments because we have seen all the 2021 madness that all these companies surprising right now go out of business or do down rounds or something like that because they got massively overfunded 2 years ago. So LPs don't deploy. And what do VCs do if they're not sure if they get more money in the future and they're sitting right now on money? They're holding on to it. And that is the reason why fundraising right now is so difficult.
Well, the founders listening that want to get in touch, they want to apply to Aurelia, where can they find you? It's clear to see that you are top tier and you're running one of the best accelerator programs in the world, actually. So Aurelia Ventures, you are very focused on B2B, but B2B is very broad. Do you have any particular investment sectors that you're actually really, really keen to see founders building products in?